Hi everyone, welcome to our client meeting. We will present the result of managing 100,000 ringgit for you. This is our team. I'm Zhao Xuli, your portfolio manager, and Praveen Kumar, our risk manager, Wang Jingchen, our trading analyst, Yashawini, our performance analyst, and Nazira, our recorder. It is our pleasure to present the performance report for you. For the past 3 weeks from December 3rd to 18th, 2025, you entrust our team with the management of a 100,000 ringgit investment portfolio. It was not merely an academic exercise for us. We approached it with the same gravity, discipline, and strategic focus as we could with real climate capital. Our mandate from you was clear: to actively manage this capital within the Malaysian equity market, with the private objectives of seeking capital appreciation while prudently controlling risks. We understood that our goal was to maximize the potential for returns, but never at the expense of exposing your capital to undue risks. Every decision we made was guided by the dual imperative to grow your investment responsibly. Over the next sections, we will walk you through our complete journey. We will explain the strategy we built, the trend we executed, the result we achieved, and most importantly, the key lessons we learned from this immersive simulation. Our report today is a transparent account from our stewardship, and we are here to present our findings and recommendations to you.
Good day, my name is Praveen and I am the risk manager of this project. I will be presenting our investment strategy, risk management plan and initial portfolio allocation for the client's RM 100,000 portfolio. In this section, I will explain the investment strategy adopted by our portfolio management team in managing the client's RM 100,000 portfolio. Our strategy followed a moderate risk, diversified equity approach with the objective of achieving capital growth while maintaining controlled downside risk. Rather than pursuing aggressive or speculative returns, our focus was on building a portfolio that balances growth potential with stability, which is more suitable for disciplined portfolio management. To support this objective, we combined fundamental, technical, and sentiment analysis in our decision-making process. Fundamental analysis was used to assess the overall quality and financial strength of companies, while technical and sentiment indicators helped us understand market behavior, price trends, and momentum. In addition, we deliberately avoided speculative and penny stocks. These stocks tend to exhibit high volatility and unpredictable price movements, which increase downside risk and make rational decision-making more difficult. Instead, we focused on well-established companies listed on Bursa Malaysia that show clear trends, stronger market presence, and more reliable performance over time. Overall, this strategy allowed us to approach the market in a structured and disciplined manner, consistent with how professional portfolio managers will manage a client's funds. Risk management was a critical component of our investment plan, as preserving capital is just as important as generating returns. To manage downside risk, stop-loss rules were applied to each position. This ensured that potential losses were controlled and prevented any single trade from causing significant damage to the overall portfolio. In terms of capital allocation, position sizing was carefully controlled to avoid overexposure to individual stocks. Rather than concentrating too much capital into one position, funds were spread across multiple stocks and sectors. This approach helped reduce unsystematic risk and improved overall portfolio stability. Diversification across sectors also played an important role in risk management. By investing in banking, utilities or power, and construction sectors, these portfolios was exposed to different economic drivers rather than relying on a single industry. Throughout the trading period, positions were monitored on a weekly basis. This regular monitoring allowed us to review market conditions, reassess our investment rationale, and exit position in a disciplined manner when conditions no longer supported our original strategy. By following predefined rules and avoiding emotional reactions, we were able to maintain consistency and control throughout the trading process. Based on the investment strategy and risk management framework discussed earlier, we then constructed the initial portfolio allocation. The portfolio consisted of 3 stocks across different sectors to achieve diversification. The largest allocation was made to HL Bank with an investment value of approximately 41,900. HL Banks was selected as a core holding due to its exposure to the banking sector, which generally provides stability, consistent earnings, and lower volatility compared to most cyclical industries. The second allocation was made to YTL Power with an investment value of approximately 32,000. This position provided exposure to the utilities and power sector, which offers relatively defensive characteristic while still presenting growth opportunities through energy demand and infrastructure development. The third allocation was made to Gamuda with an investment value of approximately 25,200. Gamuda was selected to provide exposure to the construction and infrastructure sector, allowing the portfolio to benefit from potential growth linked to long-term development projects. Overall, the allocation allowed the portfolio to remain diversified across sectors while balancing stability and growth potential. With the strategy and initial portfolio allocation established, the next section will present our trading journey and highlight the key trades and decisions made during the trading period.
Hello everyone, I'm Wang Jingcheng. It started on the afternoon of December 3rd. The market was very shocking, so at 16:14, we decided to play 8C first. We bought Hangliang back and 21.30 ringgit. Why? Because we needed a stable stock to protect our accounts. Minutes later, we saw an opportunity to make money. We saw YT Air Power drop to 3.25 ringgit. It looked too cheap, so we bought it, expecting a quick bounce. We also bought Gamda at 16.21 because of the government's new infrastructure projects. At this point, we were fully invested. We used almost all our cash, over 97,000 ringgit. We had a mix of safety and risk. But the market changed quickly. We noted something important. Gamda was weak, but YT Air Power was very strong. We had to make quick decisions. We sold Gamda and took a loss. We also sold the back stock. This left us down by about 18,000 ringgit. But we didn't give up. Instead of being scared, we bought more YT Air Power. We increased our position to 16,000 shares with an average cost of 3.28. We decided to focus all our energy on this one winner. It worked. YT Air Power jumps up, and we sold everything at 3.45. This one big trade covered all our earlier loss and put our account back in profit.
Good day, my name is Yashwini Patiban and I'm the performance analyst for this portfolio. Our portfolio started with an initial capital Ringgit Malaysia 100,000. At the end of the trading period on 18th December 2025, the financial portfolio value was Ringgit Malaysia 100,060 Ringgit 32 cent. This result is a net gain of Ringgit Malaysia 16 Ringgit 32 cent, which represent a return of 0.06%. Although the return was small, the portfolio remained profitable and showed the stability during the trading period. To assess our portfolio performance, we use the FTSE Bursa Malaysia KLCI as the benchmark, which represents the overall Malaysian stock market. The trading period for both the portfolio and the benchmark was from 3rd December to 18th December 2025. Using the same time period allows us to make a fair and accurate comparisons. The best performing stock in our portfolio was YTL Power. As a company in the utilities sector, YTL Power showed more stable price movement during the trading period. This stock contributed positively to the portfolio and helped reduce overall risk. The worst performing stock in our portfolio was Gamuda. Gamuda is one of the construction and infrastructure sector, which is more sensitive to the market conditions. During the trading period, Gamuda recorded losses which reduced the overall portfolio returns. These losses offset the gains from other stocks and were the main reason the portfolio underperformed the KLCI.
Hi, my name is Nura Nazira. For our lesson learned, I will briefly explain what worked well, what did not work well, and our teamwork reflection. First, In terms of what worked well, capital preservation was one of our strongest outcomes. By focusing only on liquid blue chip stocks such as YTL Power and Hong Leong Bank, the portfolio remained relatively stable even when market volatility increased. This helped us avoid large drawdowns during the trading period. Secondly, our band trading strategy was effective, particularly for YTL Power. By identifying oversold conditions and applying a buy low, sell high approach, we were able to offset earlier losses and contribute positively to the final portfolio return. Another important strength was disciplined risk management. Stop loss rules were strictly followed, especially when exiting Gamuda. This prevented further losses from accumulating and helped control overall downside risk. In addition, all positions were fully closed before the end of the trading period, which ensured there was no residual carried forward. However, there were also areas that did not work well. Despite making a small profit, the portfolio underperformed the KLCI benchmark mainly due to losses from Gamuda. The portfolio was also over-concentrated as we only had 3 stocks. This made overall performance highly sensitive to the poor performance of a single counter. Furthermore, tight liquidity management was a weakness. Deploying almost all capital early reduced flexibility and increased pressure during volatile market conditions. Lastly, although technical indicators were used, some trade timing could have been improved, particularly in fast-moving markets. From a teamwork perspective, clear role allocation improved efficiency. Defined roles such as portfolio manager, analyst, and risk manager ensured structured decisions making and reduced impulsive trades. Decisions were made collectively with strengthened disciplines and accountability. Overall, this simulation helped us better understand real-world portfolio management. It highlighted that success in short-term trading depends not only on returns but also on discipline, teamwork, and risk control. For our closing and recommendation, I will summarize our final outcome and advice to the client. First, regarding the objective, yes, we achieved our primary goal. The portfolio successfully preserved capital and generated a small positive return of 0.06%, increasing from 100,000 ringgit to 100,060 ringgit by the end of the trading period. Although the portfolio underperformed the KLCI benchmark of 0.95%, it remains stable in a volatile market environment. This outcome reflects our disciplined investment approach with a strong emphasis on risk management and liquidity rather than aggressive return seeking. In terms of key outcomes, losses from Gamuda were effectively controlled through strict stop loss rules, which prevented further downside risk. At the same time, gains from YTL Power and Hong Leong Bank helped offset these losses. Importantly, all positions were fully liquidated at the end of the trading period, ensuring that no residual risks were carried forward to the client. Based on this experience, we have several recommendations going forward. We suggest greater sector diversification to reduce concentration risk and improve risk-adjusted returns. Maintaining a strategic cash reserve will also increase flexibility and allow faster responses to market volatility. In addition, improving trade timing through stronger technical confirmation can enhance entry and exit decisions. Overall, the future outlook remains positive with better balance between growth, liquidity, and risk control. In conclusion, while the portfolio did not outperform the benchmark, it successfully met its core mandate of capital preservation and disciplined execution. Thank you for entrusting us with this portfolio management exercise. We truly appreciate the opportunity and the valuable learning experience it has provided.